Imagine waking up, checking your portfolio and realizing you don't just owe some money, you owe like an infinite amount of money.
Yeah, that is the literal nightmare scenario for any investor.
Right. Welcome to the deep dive. Today we are decoding basically the only financial strategy where the champagne corks pop when the market completely crashes.
It is a very different way of looking at the economy, that's for sure.
Totally. We're heading into the shadows of Wall Street today to look at short selling, and our mission is to break down the actual mechanics and honestly the catastrophic risks of this strategy.
Which is so important because, this is a sandbox that's mostly reserved for institutional investors and massive hedge funds.
Exactly. But even if you, the learner listening right now, never actually execute a short trade, understanding how this works is the ultimate shortcut. It's the decoder ring you need to finally make sense of those really confusing financial headlines.
Right, like headlines about market volatility or meme stocks.
Or billionaires just losing everything literally overnight. So, okay, let's unpack this. Because to even understand what a short sale is, which is making a profit when a stock's value goes down instead of up,
Right.
we actually have to fight our own biology a little bit. Human brains are hardwired chronologically, We experience time moving forward.
Yeah, the basic concept of commerce makes perfect logical sense to us.
Yeah.
You buy something at a low price, you wait, and then you sell it at a high price.
Exactly. But to grasp short selling, you have to completely reverse your logical thinking.
You're basically flipping time on its head.
Yeah, you have to figure out how to sell something you don't even own yet and then buy it later.
It really is an exercise in reverse engineering your entire concept of ownership. Like, you are selling first and buying second.
Which is so weird.
It is.
Yeah.
And that chronological flip is
Mhm.
exactly what makes the actual mechanics of this so deeply counterintuitive for most people when they first encounter it. You are intentionally entering the market in reverse gear.
So I was trying to wrap my head around this chronological flip, and I came up with an analogy. I want to test this on you to see if it actually maps to the real market mechanics.
Okay, let's hear it.
Imagine your neighbor has this beautiful brand new lawnmower, and it's worth exactly $100.
Right.
But you know for a fact that the hardware store across town is about to put that exact same model on a massive clearance sale next week.
Okay, I see where this is going.
So you go to your neighbor and say, "Hey, can I borrow your lawnmower for a week?" And your neighbor says, "Sure."
Generous neighbor.
Right. So you take that borrowed lawnmower, walk straight down to the local pawn shop, and sell it immediately for $100 cash.
You just sold your neighbor's lawnmower.
I did, and I put that $100 bill right in my pocket. So right now, I don't own a lawnmower, but I do have $100.
Which you didn't have before.
Exactly. So a week goes by. The hardware store puts the lawnmower on clearance for $50.
Mhm.
I take my $100 bill, walk into the store, spend $50 to buy the brand new lawnmower, and then I return it to my neighbor.
So you gave back exactly what you borrowed.
Yeah, but I still have $50 left over in my pocket. I just made a $50 profit off something I never actually owned.
That actually perfectly captures the essence of the strategy.
Yeah.
It strips away all the Wall Street jargon and gets right down to the core mechanism.
Oh, toss.
Because like you said, you cannot sell what you don't have.
Yeah.
So it all has to start with a loan. In the financial world, you accomplish this through your brokerage firm.
Okay, so when I click sell short on my trading platform,
Your broker actually goes and finds those shares to lend you.
wait, where do they even get them? They aren't just materializing shares out of thin air, right?
No. Usually they are lending you shares that are held in the margin accounts of their other clients.
Oh, wow.
Yeah, the broker facilitates this because it's highly lucrative for them. They charge you fees and interest for the privilege of borrowing those shares.
Makes sense. So the broker lends me the shares and I instantly sell them on the open market.
Exactly. You convert that borrowed asset into cash at whatever the current market price is. And then you wait for the price to drop.
Like waiting for the clearance sale.
Precisely. And when it drops, you buy the shares back at that new lower price and hand them back to the broker to close out your loan.
Okay, let's actually put some real numbers to this to see exactly how the math plays out in the actual stock market. So if I identify a stock trading at, let's say, $100 per share,
Okay.
and my research tells me this company is fundamentally broken and the value is about to tank.
So you go to your broker and borrow, let's say, 25 shares. You immediately sell those 25 shares on the open market. Boom. You now have $2,500 cash sitting in your account.
Okay, and then let's say my prediction is dead on. The company releases a terrible earnings report, the CEO resigns, and the stock price just plummets to $50 per share.
This is where you close the trap. You take your cash and you buy 25 shares at the new $50 price. That costs you $1,250.
Right.
You hand those 25 shares back to the broker to repay the original loan. Out of your original $2,500 in cash, you spent $1,250 to buy the shares back.
Meaning the remaining $1,250 is just my pure profit.
Exactly.
Minus whatever interest I owe the broker for borrowing the shares in the first place, of course.
Right, precisely. You always have to, minus the borrowing costs.
Now, when we lay the math out like that, it honestly sounds like an easy money glitch. You know, you find a bad company, borrow the stock, sell it, wait for the inevitable crash, and scoop up the difference.
It sounds easy in theory, yeah.
But if we pull back and look at the bigger macroeconomic picture, the entire historical trend of the stock market, I mean, over decades and decades, is always moving upwards.
Very sure.
The market is fundamentally designed to grow as the economy grows. So if the baseline trajectory is upward, aren't short sellers basically just constantly fighting gravity?
That's exactly what they're doing.
Yeah.
They are absolutely swimming upstream against the long-term trend of the market.
Mm-hmm.
And because you are fighting gravity, the consequences of being wrong are, frankly, uniquely devastating.
Oh, yeah.
This is why this strategy requires such intense risk management.
Which brings us to the dark side of this equation. Because if I buy a normal stock taking a traditional long position, let's say I invest $1,000, the absolute worst case scenario, the floor, is that the company goes totally banked out.
And the stock goes to zero.
Right. I lose my $1,000. It hurts, but my loss is capped at exactly what I paid. I know the maximum damage the moment I buy in.
Yes, your risk is defined.
But when you are shorting a stock, you are stepping into a mathematical reality that is just terrifying.
It is the math of unlimited loss. And this is the single most crucial concept for anyone trying to understand why short selling can destroy massive institutions overnight.
Unlimited loss.
Think back to your lawnmower analogy. Your obligation isn't to pay back a specific amount of money.
Oh, right. I have to return the physical lawnmower.
Exactly. Your legal obligation is to buy back the physical shares and return them to the lender, whatever the market price happens to be at that moment.
So if I short 100 shares of a stock at $100 per share, expecting it to drop,
Right.
but instead the company announces a massive technological breakthrough and the stock price doubles to $200.
You are still legally obligated to buy back those shares to return them. You now have to come up with an extra $100 per share out of your own pocket.
Wow. So for 100 shares, I am instantly bleeding a $10,000 loss.
Yes.
And there's literally no mathematical ceiling to how high a stock price can climb.
None whatsoever. Let's look at an extreme hypothetical scenario to really illustrate the danger here.
Yeah.
Imagine you short a penny stock at $1 per share. You are completely convinced it's going to zero. But suddenly, something insane happens, like a massive acquisition or a viral trend.
Oh, no.
And that stock rockets to $100,000 per share. You still have to buy those shares back.
Wait, so I borrowed something for $1 and I am now forced to buy it back for $100,000.
Exactly. Your potential for loss isn't just large. Mathematically, it is completely uncapped. It is infinite.
That is just a staggering amount of systemic risk to take on. And the pain doesn't even stop at the stock price itself, right? Because there are all these hidden costs just bleeding you dry while you wait for the stock to drop.
Oh, definitely.
You're paying margin interest on the value of the shorted stock the entire time you hold the position. It's like you're paying rent on the lawnmower.
Yeah, borrowing an asset is never free. The broker is taking on risk by lending to you, and they charge you daily for that privilege. And if interest rates fluctuate, that silently eats into your profit margins too.
But the hidden cost that really blew my mind, because it just perfectly highlights how inverted this whole strategy is the dividend trap.
Ah, yes. The dividends.
In normal investing, if a company pays a dividend, which is a share of its profits, you get a nice little check in your account.
A nice little bonus.
Right. But if you are shorting a stock and that company pays a dividend while you hold the short position, you don't get that money. You actually have to pay that dividend amount out of your own pocket.
You do.
Why on earth would the short seller be responsible for paying a dividend?
It all comes back to the mechanics of the loan. Remember, you borrowed those shares from an original owner, likely someone else's margin account.
Right.
That original owner still rightfully expects their quarterly dividend. They didn't sell their shares.
Mm.
But because you took their shares and sold them to a new buyer on the open market, the company is now paying the dividend to that new buyer.
Oh, I see. So the original owner is just sitting there empty-handed.
Exactly. So, to make the original owner whole, your broker reaches into your account, takes the equivalent dividend amount out of your cash, and hands it to the original owner.
So you are bleeding daily margin interest. You are paying out dividends from your own cash reserves, all while staring down the barrel of potentially infinite losses if the stock happens to tick upwards.
Which is exactly why you have to be right about the company failing. And you have to be right about the exact timing. Every single day you wait costs you real money.
But, all of these risks assume that the market is behaving logically.
Sure.
It assumes that if a company has bad fundamentals and is poorly managed, the stock will naturally go down, and the short seller will eventually win if they just wait it out.
That's the theory.
But what happens when market momentum completely ignores financial reality? Like, what happens when a failing company accidentally becomes a financial weapon against the short sellers themselves?
Oh, boy.
Here's where it gets really interesting, because you can't decode short selling without understanding the explosive chain reaction of a short squeeze.
A short squeeze is the ultimate nightmare scenario. But before we even get to the squeeze itself, we have to look at a foundational supply problem.
Okay, what's that?
The golden rule of this strategy is,
Yeah.
you cannot short what you cannot borrow. If there aren't enough available shares floating around in the market, the entire mechanism just breaks down.
Right, because certain stocks are notoriously hard to borrow, like companies like Joanne, ticker symbol JOAN, or Allogene Therapeutics, ticker symbol ALLO. They frequently see incredibly low share availability.
And if share availability gets too tight, the broker lending you the shares can issue a recall.
A recall.
Yeah, they can simply tap you on the shoulder and say, hey, we need those shares back immediately. And you are then forced to close your short position on the spot.
Even if you're losing money.
Yes. You have to buy the shares back right then and there prematurely, regardless of whether the price has dropped or spiked. It completely strips away your ability to wait out the market.
So you're already operating in this highly fragile state.
Mm-hmm.
And then we get to the phenomenon of the squeeze. And we have this most spectacular, historic, real-world collision of all these risks happening at once, which was GameStop in 2021.
GameStop is the textbook example of market momentum violently overriding fundamental financial reality.
I mean, everybody remembers the headlines, but walk us through the mechanics of what actually happened.
Well, GameStop, as a brick-and-mortar video game retailer, was seriously underperforming on a strictly financial basis. Their business model was struggling in a digital age.
Makes total sense.
So, numerous massive Wall Street hedge funds looked at the spreadsheets, saw a dying company, and took out massive short positions. They bet heavily that GameStop was going to crash.
And it was a perfectly logical bet based on the company's actual performance metrics. But the market isn't a spreadsheet. It's made of human beings.
Exactly.
And what happened next was this historic retail rebellion. Small, everyday investors congregating on internet forums realized that these massive hedge funds had overextended themselves.
They had shorted millions and millions of shares, creating a massive vulnerability.
So these everyday investors started buying up GameStop stock en masse. This was basically the birth of the meme stock phenomenon. And as all these small investors started aggressively buying, the price of GameStop started to climb.
And this is where the mechanics of short selling become a lethal trap.
Right, the infinite loss.
Yes. As the price goes up, those hedge funds start bleeding massive amounts of money. Their potential for infinite loss is suddenly staring them right in the face.
Because the stock is rocketing upward.
Right. And it isn't just a psychological fear for these funds, it's a mechanical trigger. Because they are losing so much money, their brokers issue what's called a margin call.
Ooh, a margin call.
The brokers essentially say, your account is bleeding too fast, post more collateral right now, or buy the shares back immediately to close the bet before we are left holding the bag.
And how do you close a short position? You have to buy the shares.
Exactly. But buying millions of shares to cover their positions drives the stock price up even further. It creates a violent, self-sustaining feedback loop.
Wow, so the retail investors are buying, pushing the price up.
Yes.
This triggers margin calls for the desperate hedge funds, forcing them to also start aggressively buying just to stop their infinite losses, which pushes the price up astronomically faster.
This frantic, forced panic buying by the short sellers is the literal definition of a short squeeze. It forced GameStop stock price up an unbelievable 700% in early 2021.
700%.
The carnage on Wall Street was unprecedented. Melvin Capital, which was a highly respected massive hedge fund, lost 53% of its total value in January of 2021 alone.
Half of their wealth.
Wiped out in a matter of weeks, simply because they were caught on the wrong side of a short squeeze.
I mean, a 53% loss in a single month for a massive institution, that is the kind of explosive, systemic event that usually brings the referees running onto the field, right?
No, absolutely. Yeah.
You can't just have multi-billion-dollar hedge funds vaporizing overnight, threatening the broader financial ecosystem without governments and regulatory bodies getting involved. How does an entity like the SEC actually police a strategy that is capable of causing this level of absolute market chaos?
Well, the primary weapon regulators use is forced transparency.
Okay.
Historically, institutional short sellers operated entirely in the shadows. They didn't have to disclose these massive bets against companies. But the fallout from GameStop and other market disruptions led to significant regulatory changes.
What kind of changes?
Just recently, in 2023, the SEC passed a new rule requiring institutional investors to officially publish their gross short positions on a monthly basis.
Interesting.
The goal is to pull these massive bets out of the dark. By doing so, regulators and the broader public can actually see where systemic risks are building up before they explode.
Which makes sense. You want to know if a fund is massively over-leveraged.
Yeah.
But there are also rules about the actual minute-to-minute trading mechanics, right?
Yes, there are.
I'm looking at something called the uptick rule. It seems to dictate not just who can short, but when a short can actually happen. Can you clarify the mechanism there?
Sure.
Because it sounds like a literal speed bump designed to stop short sellers from just piling on and crushing a struggling stock into oblivion.
That's exactly how it functions. It's a structural circuit breaker. The history of the uptick rule is actually quite fascinating.
How did it used to work?
Prior to 2010, the rule was universal and very strict. You could only execute a short sale on an uptick, meaning the most recent trade of that stock had to be at a higher price than the prior one.
Oh, wow. So you physically could not short a stock while it was actively ticking down.
No, you couldn't. You had to wait for a tiny upward bounce in the price. The mechanism was meant to prevent short sellers from aggressively driving a stock price into the ground during a panic.
But they changed it.
Yes, the SEC greatly modified this in 2010. Today, the rule is much more targeted. Now, that uptick restriction only kicks in for stocks that have already lost more than 10% of their value in a single trading day.
Okay, so it's a dynamic shield.
Exactly.
If a stock is having a normal day, short sellers can trade freely. But the moment it hits that 10% free fall threshold, the modified uptick rule steps in to make it mechanically harder for short sellers to accelerate the crash.
It gives the stock a chance to breathe. It prevents a coordinated dogpile.
It's fascinating to see how the U.S. tries to manage it with these nuanced speed bumps and transparency rules. But if we broaden the lens here, how does the rest of the world handle this?
It varies significantly.
Because I have to imagine other governments look at the infinite loss potential, the margin called death spirals, the meme stock chaos, and just think, why even allow this practice inside our borders?
It's a very valid perspective. And while short selling is not generally banned globally on a day-to-day basis, international regulators treat it with extreme caution, particularly during times of widespread economic panic.
Like when?
Look back at the 2008 financial crisis, when the entire global banking system was teetering on the edge of collapse. Many countries simply pulled the plug entirely. Yes, the US, the UK, Australia, Canada, they all instituted broad temporary bans on short selling.
Because they didn't want speculators actively betting on the collapse of financial institutions and potentially creating a self-fulfilling prophecy of doom.
Precisely. The fear was that aggressive short selling would erode public confidence so quickly that healthy banks would fail simply due to the panic.
Wow.
But some countries have taken it even further recently. South Korea represents the most drastic regulatory approach. They didn't just tweak the rules. They implemented a comprehensive outright ban on all short selling that extended through March 30th, 2025.
An outright ban.
And this wasn't just a slap on the wrist for violators. Severe criminal penalties applied to anyone caught attempting to short sell during that period.
So actual jail time for executing a trade.
Yes. Now, the ban has since been reinstated as markets stabilized, but the fact that a major global economy utilized criminal penalties shows just how seriously international regulators view the destabilizing potential of this practice when the market is vulnerable.
Okay, We have synthesized a massive amount of complexity here today.
We really have.
We've broken down the chronological flip of borrowing shares. We've looked at the terrifying mathematical reality of infinite uncapped losses and the daily bleeding of margin
The
interest.
dividend traps, too.
Yes, we've explored the sheer mechanical chaos of margin calls during the GameStop short squeeze. And we've seen major global economies implementing outright bans. So the ultimate question for the learner listening to this right now has to be, with all this complexity, all this regulation, and all this catastrophic risk,
Yeah.
why does this strategy even exist in the first place?
That is the million-dollar question.
What are the actual functional pros that make professionals keep utilizing it?
Well, despite the intense dangers, short selling provides several critical utilities that make it an indispensable tool for institutional investors.
Okay.
First, it is the only viable mechanism to generate high profits in a broadly declining market.
Yeah.
If the overall economy is entering a deep recession, traditional long investors are forced to sit on their hands and watch their portfolios bleed. Short sellers are the ones still generating active returns when the market turns red.
So they are the only ones finding opportunity in a downturn, but it's also used defensively, isn't it, as a hedge?
Yes, hedging is arguably its most important institutional function. Think of it as an insurance policy.
How does that work?
Well, if a massive fund holds billions of dollars in long-term tech stocks that they genuinely believe in, they are still exposed to a broader sector crash. To protect themselves, they might short a broader tech index.
Oh, okay.
That way, if the whole sector suddenly drops, the profit from their short position directly softens the blow of the losses in their long position. It stabilizes their overall portfolio.
And it also creates immediate liquidity, right? If a hedge fund desperately needs cash right now to fund another operation, shorting allows them to generate that cash instantly without being forced to liquidate their long-term winning stocks to get it.
Exactly. It's a highly flexible financial tool. And finally, there is the undeniable appeal of leverage. By borrowing shares on margin, you can command a massive market position with relatively little upfront capital. It allows institutions to massively magnify their gains.
Oh, as we've thoroughly discussed today, that leverage works both ways. It magnifies your losses just as violently when the market turns against you.
Very true.
So, what does this all mean? The bottom line for you, the listener, is this. Unless you are managing a multi-billion-dollar hedge fund, the consensus is that beginning investors should steer well clear of actually executing a short sale.
The risk of infinite loss is just too astronomically high.
Exactly. But understanding this high-risk, high-reward ecosystem is absolutely crucial. As we said at the start, this is your decoder ring.
Yeah.
When you see a struggling company's stock inexplicably spike 700% for no underlying financial reason, you now know the margin call mechanics of the squeeze driving it.
You understand the gears turning behind the scenes.
Right. When you see a titan of Wall Street lose half its value in 30 days, you understand the infinite math that caused it. And when international governments hit the panic button and threaten criminal penalties, you know exactly what systemic collapse they are trying to prevent.
It's about finally seeing the full chessboard. You simply cannot understand the market's complete movements by only looking at the people betting on success. To understand the full picture, you have to understand the intricate mechanics of the people betting on failure.
Which leaves me with one final provocative thought for you to ponder on your own. We talked earlier about how the SEC passed that new law in 2023, forcing massive hedge funds to pull their gross short positions out of the shadows and publish them monthly to improve market transparency.
Right.
The goal was to make the market safer. But think back to the mechanics of the GameStop narrative.
Okay.
That historic retail rebellion only happened because small investors managed to figure out exactly which stocks the big funds were massively overextended on.
Oh, wow. I see where you're going with this.
So if these new SEC regulations now force hedge funds to publish all their short positions for the whole world to see on a regular basis, could that very transparency actually backfire?
That's a fascinating question.
By trying to protect the market, are regulators accidentally handing millions of internet-savvy retail investors a monthly, publicly available treasure map? A map they can use to coordinate the exact same kind of devastating short squeezes that destroyed Melvin Capital.
It is a profound paradox.
Whether bringing these secretive bets into the light actually makes them fundamentally more explosive. We'll leave you to chew on that.
A lot to think about.
Thank you so much for joining us on this deep dive into the upside down of Wall Street. If you found these insights valuable and you want to keep expanding your decoder ring, please hit that subscribe button, share this with a friend, and keep questioning how the machinery really works. We'll see you next time.